Some modern corporate annual reports clock in at over 100,000 words. For years, the financial industry has debated how to manage this sheer volume of text. Regulatory bodies like the SEC and FASB view this massive text as a risk. They argue that disclosure overload harms the market, burying retail investors in irrelevant details and obscuring a company's actual health. But for quantitative analysts and portfolio managers, the perspective is the opposite. To a professional building a valuation model, there is no such thing as too much useful data. The actual bottleneck is not the density of the information, it is the format. Regulators are forcing a 20th century human consumption format onto a 21st century machine-driven profession. Information overload is a data architecture problem. Solving it requires moving past the static document towards source-level, machine-readable structured data. When an analyst populates a financial model today, they are often forced to manually scrape data from static PDFs or HTML files, visually hunting for the correct line items. This physical rekeying process is highly fragile. A single transcription error can compromise the integrity of an entire valuation model. This creates a significant opportunity cost. Highly compensated analysts are spending their research hours on clerical data collation rather than true analysis. As long as financial data remains bounded by the document it is published in, the finance industry is operating at a severe efficiency deficit. To see the operational friction of this unstructured pipeline, we can look at the reporting workflow used by United Technologies Corporation. UTC collected financial data from global locations across disparate ERP systems. Data funneled into consolidation software, then was manually rekeyed into a Word document. This workflow required 845 hours per quarter. Because data moved manually, 20% of time was lost to manual proofing. This legacy pipeline is being replaced by disclosure management applications. By tagging data at the source, the software automatically assembles and validates the report. The data is never manually copied, which removes the need for manual proofing and reclaims hundreds of hours of labor. Standardizing data early in the process transforms regulatory compliance into a streamlined operational advantage. This standardization relies on XBRL, a machine-readable dictionary of tags mapped to US GAAP. The primary barrier to XBRL adoption is when firms treat it as a bolt-on compliance chore rather than foundational architecture. This represents the standardized US GAAP taxonomy, built to be uniform. But uniformity is threatened by custom tags or extensions. Intended for unique scenarios that don't fit the dictionary, these custom extensions now make up roughly 30% of tags used by US companies. Excessive customization prevents cross-company comparability. It breaks automated analysis algorithms and forces analysts to manually map the data yet again. Without strict enforcement of taxonomy standards, the promise of democratized instant data querying fails. Structured data simultaneously transforms internal corporate control and the audit function. Traditional audits are periodic and backward-looking, relying on statistical sampling because testing every transaction is labor-prohibitive. But when transactions are formatted in machine-readable code, firms can deploy audit data analytics. Assurance changes when auditors move from analyzing a random sample to analyzing 100% of a transaction population. This shift enables continuous auditing. Algorithms can flag anomalies and risk trends the moment they occur, rather than months after the books are closed. By integrating continuous oversight into enterprise risk management, structured data moves beyond reporting history to actively securing the company's present operations. This loop represents the virtuous circle of a structured data landscape. Source data tagging enables automated audits, resulting in machine-readable filings for algorithmic consumption. Eliminating manual data preparation reclaims thousands of hours previously lost to clerical tasks across the investment industry. Those freed hours allow analysts to broaden their coverage, specifically focusing on small to mid-cap equities. Historically, these smaller firms were often ignored by major funds, purely due to the prohibitive labor cost of manually analyzing their unstructured filings. Modernizing financial reporting architecture directly increases market liquidity and unlocks higher return alpha opportunities that were previously hidden by friction. For the modern investment firm, manual data scraping and spreadsheet transcription are permanently obsolete. Survival today requires T-shaped investment teams. The horizontal bar of the T is broad fluency in data science, including database logic and the ability to manipulate structured data at scale. The vertical bar is deep traditional financial domain expertise, the rigor of professional accounting, risk analysis, and valuation. Because data is instantly democratized via technology, competitive advantage has shifted from data gathering to data modeling. As paper dissolves into code, only professionals bridging data science and financial rigor possess the tools to generate alpha in the 21st century.